Hi students, welcome to another accounting lesson. Today we're going to look at one of the methods that we use to evaluate whether or not it's worth having a capital investment decision, and that method today is called the payback period. Remember from previous lessons, a capital investment decision is a pretty big decision basically because we're buying big items like a motor vehicle, or we might be buying or investing in another asset, or we may be buying some new machinery, new buildings, maybe introducing a new product. And so obviously the impact of that decision is going to last for a long, long time. And it's not easy to reverse that decision. So today we're going to look at what we call the payback period, and that gives us a little bit of a clue as to how to work out or how to evaluate this project. So I'm going to use a simple example today, but just before we start looking at the payback period, there's some terms that we need to become familiar with. And let's say, for example, we're going to start a new business, call it Vecchio's Ice Creams, and he's thinking of investing in a new motor vehicle, which you can see in this top corner here. And so we tend to say that this is the initial cost of the investment. And if we're saying the cost of that investment is $14,000. So let's say it's going to cost $14,000 to buy this new motor vehicle, which obviously is going to generate us income over the next few years. When we evaluate the payback period, we deal with cash flows only. So we're not using accrual accounting here, but we're using cash flows because it gives us greater meaning, and you'll see that in a moment. So if you have a look at the table here, you'll notice what I've done is I've looked at the cash inflows. So the expected sales are 10,000, 10,000, 10,000 per year. And that's just a rough estimate of what we expect to earn each year from selling ice creams. Of course, we're going to have some outflows, and our outflows or our cash expenses, which is obviously the cost of buying the ice cream, starts from year one, 3,000, 3,000, 3,000, 3,000. And so to keep our example very simple, you'll notice that at the end of each year, our net cash flows are the same each year. Now, what happens when we evaluate capital projects is that now is termed to be year zero. So this is usually the time at which we purchase that asset. And then obviously any income that's generated in that first year is said to be year one's income, and so on. So you'll see that right now we're outlaying $14,000 in the hope of generating $28,000 over the next 4 years. Now we're assuming here the motor vehicle has no residual value. So at the end of the 4th year, we're basically going to scrap this motor vehicle. So we want to know today, is it worthwhile going ahead with this project or not? So one of the methods we're going to use is the payback period. Now every year we're generating income. So the payback period, if you like, is how long is it going to take for the net cash flows to cover the initial outlay. And that's pretty simple. If we've spent $14,000, the truck's going to pay for itself in 2 years' time. Now today's example is quite straightforward, quite easy. Now in your formulas booklet, if you have a constant cash flow every year or net cash flow every year, then the payback period is quite a simple thing to calculate. We say that the payback period, and this formula is in the back of the booklet, is the initial cost of investment over the annual net cash flows. Now, as I said, today's example is pretty easy. So it's costing us $14,000 to buy this new truck. We expect to be generating net cash flows of $7,000 per year, and so that gives us a payback period of 2 years. Okay, pretty simple example to start with today. The significance of this is the longer the payback period, the worse it is. The shorter the payback period, the better it is, because you can imagine things might go wrong in the future, and something might happen and people stop buying ice creams, and therefore it might not be a viable business in 3 or 4 years. So management do decide in most companies what they believe is an acceptable payback period for their business and in their circumstances. And this varies from business to business. So 2 years is not like a standard payback period for projects. It is in this example, but it doesn't have to be in others. So let's have a look at a more complex example. Let's say that this company called Pretty Print has got a whole lot of machinery in its warehouse, and now they have discovered that there's a brand new piece of machinery on the market that prints these colour products in glossy materials and comes up with a better magazine at the end of it all. So they're looking at buying this particular machine, and so as you can see here from the cash flows, the cost of the machine that we're hoping to buy is $450,000. So a little bit more money we're spending here. It's going to have a useful life of 5 years, and then at the end of the useful life, it's going to have a residual value, or we think we can still sell it for $22,000. Okay, so what I'm going to do now is turn your attention to the net cash flow table that we've prepared here. Remember, this table is prepared in planning for the purchase of this asset. So these are estimated figures. Well, let's have a look. Management has or believes that additional sales are going to be 135,000, then 140, 150, then 120, then 150. These are projected sales or additional sales to what we're currently making. So if we buy this machine, we're expecting to make additional sales. So it's the additional sales or incremental sales that we include in our decision. We also find that if we do buy this new machine, we're not going to have to employ one of the guys or a couple of the guys because the machine is more efficient. So we're going to be saving $55,000 a year in wages. And that's considered to be an inflow, so it's a saving in an expense. And then in year 5, when we sell the asset, we expect to generate $22,000. All right, the cost of the project is now in year 0. So you notice that we show that as an outflow in year 0. And then we've got our additional expenses of running this machine, like electricity and other items. These are the cash expenses. So you'll notice that they're different every year. So now what we notice about the net cash flows is that in year 1, it's 148,000. In year 2, it's 143. Year 3, it's 142, then 102, and then 149. So now you're going to find that we can't use the formula to work out the net cash flows. And the reason we can't use the formula is the cash flows are all different. Okay, so how do we work out the payback period using different or differing net cash flows? So when the cash flows are different, how do we work it back? Well, the easiest way to start is to start with the cost and start working out how we recover that. So we start off with that cost of $450,000. Now, in year one, we're going to generate $148,000. So that's going to leave us $302,000 that needs to be recovered. So the cash flows from year two are going to be $143,000. So it leaves us $159,000 to recover. The cash flows in year three are going to be $142,000. So that leaves us $17,000 still to be recovered in year four. So now in year four, if we have a look at year four, the cash flow is $102,000. So that project's going to pay for itself between year three and year four. So let's have a look at how we would deal with that. So the cash flow from year four is $102,000. Okay, so because the payback period is between year three and year four, we now need to see how long it's going to take to recover that $17,000 in year four. So we know the payback period is definitely 3 years and something. Now that something is we're going to recover $17,000 over that $102,000. So that's going to take us $0.1667 of a year. Okay, or another way of working that out is to multiply that by 12 months. And that says, okay, 0.1666 times 12 gives you 1.99 or 2 months. So the payback period is 3 years and 2 months. So I just want to go through this just very briefly because it looks complex, but it's actually quite straightforward. So remember, we started off with $450,000 as the cost of our project, and every year it starts paying for itself. So in year one, it pays $148,000, so we're down to $302. In year two, we're generating another $143. In year three, another $142. And so between year three and year four, we have to recover $17,000 from this 102. So we're trying to work out how long it takes to recover that. So we're saying the payback period is 3 full years plus 2 months. So it's going to take 2 months to recover that $17,000 from the $102,000. Now, the management of the company may have a rule regarding projects. They might say that any project that takes longer than 3 years to pay for itself, we're not going to be interested in. So it might have a decision rule within the company that anything over 3 years, we don't go ahead with the project because it's too risky. So because this is 3 years and 2 months, it's pretty close to the 3 years, but technically they would then say, well, no, we're not going to go ahead with the project. Okay, so that's how you calculate the payback period. And I guess the only difficult thing here today is when the payback period is different each year, then you have to use this way of working it out. Another easy way of doing it, you could have added up there and say, well, after 3 years, it's going to pay for itself between year 3 and year 4, and we've got to recover 17,000. Anyway, the best way to do this is to go ahead and do the practice, and good luck with that, guys. Thank you for listening.